Welcome to our deep dive on the IRS's 7% interest rate for the first quarter of 2026. In this video, we'll explain what the rate is, how it applies to both underpayments and overpayments, and what action steps you can take to avoid unnecessary costs. We'll also include quick quizzes to test your understanding. First, let's review the roadmap for today. Here's our agenda. We'll define the 7% IRS rate and why it matters, explore how it affects you whether you owe taxes or are due a refund, explain why intentionally overpaying is usually a poor strategy, give you a practical action plan, run through a couple of quick quizzes, and finish with key takeaways and next steps. Now, before we dive in, a brief but important disclaimer. This content is for educational purposes only and does not constitute tax, legal, or financial advice. Your situation may be unique, so consult a qualified tax professional for personalized guidance. With that squared away, let's define what the 7% rate actually is and where it comes from. For the first quarter of 2026, beginning January 1st, the IRS interest rate is 7%. This single figure applies to both underpayments you owe and overpayments or refunds the IRS owes you. The rate is set quarterly based on the federal short-term rate plus 3% for individuals. It serves two purposes: to motivate timely payments and to compensate taxpayers for delayed refunds. Next, let's look at why this 7% rate is a double-edged sword. The 7% rate is a double-edged sword. If you underpay during the year, interest at 7% can be charged. Treat this as a costly, mandatory debt. If the government delays your refund, you may receive interest at the same rate. The rate is determined quarterly based on the federal short-term rate, plus 3% for individuals. Despite the seemingly attractive return, trying to exploit refund interest by overpaying is usually a bad move due to processing delays and loss of liquidity. Next, we'll visualize the decision of whether overpaying to earn interest makes sense. This flowchart walks through the decision. Starting with the question of overpaying to earn 7%, we immediately test for near-term cash needs. If you need liquidity, do not overpay. If you can tolerate delays, we still ask whether you have better, more accessible options. Even if you answer yes to those questions, the conclusion is to avoid intentionally overpaying and instead focus on accurate, timely payments. On a separate branch, if you are underpaying, expect interest charges and increase withholding or estimated payments accordingly. Now, let's detail how underpayment interest works and the key dates involved. Underpayment interest applies when you fail to pay enough tax during the year through withholding or estimated payments. For Q1 2026, the applicable rate is 7%, calculated quarterly from the federal short-term rate, plus 3% for individuals. To avoid these charges, adjust your withholding and make timely estimated payments aligned with the standard due dates, usually mid-April, mid-June, mid-September, and mid-January of the following year. Coming up, we'll move from understanding to action with a practical step-by-step plan. Here are the steps. First, check current withholding using your pay stub and a reputable estimator. Second, project your 2026 income and deductions and refresh those projections quarterly. Third, calendar the standard estimated tax deadlines and set reminders. If you are behind, increase withholding or make a catch-up estimated payment. Avoid deliberate overpayments simply to earn the 7%. Prioritize liquidity and control. Track your refund. If delays occur, the IRS usually includes interest automatically without extra forms. If you receive a notice, read it carefully and respond promptly. Next, let's contrast underpayment and overpayment side by side. On the left, underpayment. The 7% functions like a costly, mandatory charge. It is avoidable with accurate withholding and estimated payments, and if ignored, it erodes your cash flow over time. On the right, overpayment. You might receive 7% interest if your refund is delayed, but that does not justify intentionally overpaying. The liquidity you surrender and the uncertainty on timing make it unattractive. The right actions are to pay accurately and on time, and if the IRS owes you interest due to delays, they generally add it automatically. With that comparison in mind, let's see a quick sequence of how money flows in each scenario. This sequence diagram shows two paths. In the underpayment path, a taxpayer pays too little during the year. The IRS assesses interest at 7% until the taxpayer increases withholding or makes an estimated payment. In the overpayment plus delay path, a taxpayer files accurately and expects a refund. If the IRS processing is delayed, the IRS may add interest at 7% and eventually pays the refund plus interest. However, intentionally overpaying to chase this interest is discouraged because you lose liquidity and face unpredictable timing. Now let's reinforce learning with our first quiz. Quiz time. The question is, true or false, it's smart to intentionally overpay your taxes to earn the IRS's 7% interest in the first quarter of 2026? Option A. True, it's a guaranteed high return with quick payout. Option B. False, processing delays and liquidity loss make it a poor strategy. Option C. It depends. Overpaying is better than any savings account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is false. Even at 7%, intentionally overpaying ties up your money and exposes you to unpredictable processing delays. The better approach is accuracy and timeliness. Next, we'll highlight why gaming the system can backfire with a quick visual reminder. Here is the bottom line on gaming the system. Delays can persist for months. Liquidity matters. Keeping your cash accessible can be crucial for emergencies or opportunities. The interest you might earn often does not justify the uncertainty. Accuracy and timeliness beat attempts to arbitrage the tax system. With that caution in mind, let's move to our second quiz to check your understanding of how the rate is set. Second quiz. For individuals, the IRS 7% rate in the first quarter of 2026 is based on which benchmark? Option A. Federal short-term rate plus 3%. Option B. 10-year Treasury yield. Option C. Inflation rate plus 2%. Option D. Prime rate minus 1%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the federal short-term rate plus 3%. The IRS sets individual overpayment and underpayment rates on a quarterly basis using this benchmark. With that clarified, let's condense everything into a quick reference table and then key takeaways. This table summarizes the differences. Underpayment results in interest charges near 7% that you want to avoid by increasing withholding or making estimated payments. Overpayment may result in the IRS paying you interest if your refund is delayed, but you lose liquidity while you wait. The recommended strategy is to pay accurately and on time, and let the IRS compute any interest owed to you due to delays. Now, let's capture the main takeaways. The key points are as follows. First, the 7% rate applies to both underpayments and overpayments. Second, you can avoid underpayment charges by maintaining accurate withholding and estimated payments. Third, do not intentionally overpay to earn interest because delays and loss of liquidity undermine the benefit. Fourth, if interest is owed to you due to refund delays, the IRS usually adds it automatically. Overall, stay timely, accurate, and mindful of cash flow. Finally, let's wrap up with next steps and a call to action. To wrap up, confirm your withholding and schedule quarterly reminders. Use realistic projections to avoid surprises. File accurately and resist the temptation to overfund the IRS. If your refund is delayed, monitor the status. Interest, if due, is typically added automatically. Up next is our closing message and a final nudge to engage with the channel. Thanks for watching. If this video helped, please like, share, and subscribe, and let us know in the comments how you plan to handle the 7% rate for the first quarter of 2026. Your feedback helps us create better content, and we'd love to hear your questions and strategies.